and welcome to episode 2 of Clear Financial Meeting Our Partners. I'm here today in Blackrock in Zurich's head offices to meet with Ian Slattery. Ian, how are you doing?
Good, not too bad. How are you?
Very good, very good. For those of you who don't know Ian already, Ian is the head of investment solutions at Zurich, and he's a Dublin man through and through.
I am indeed, yeah. I don't make it up your way too often.
No, and likewise, it's a real case of town mouse, country mouse today.
Very much so.
Ian, one of the things that I wanted to ask you today was to maybe lift the lid a little bit in terms of your investment team and what you do. Because when I'm talking to clients and I talk about Zurich, I always just mention the fact that you're obviously a very large global brand, but your investment office is actually based here in Ireland at Blackrock. Can you tell me a little bit about your team, maybe just the size of the team and how you operate?
Yeah, so as you mentioned, we are a global insurer and asset manager with hundreds of billions of dollars and euro under management, but we do have the team here that's been based in Dublin for well over 30 years and operate out of this building here. So we manage just about 30 billion euro for Irish people, so people who are saving for retirement or an investment or whatever it might be, and also provide protection products and things like that as well. So as I said, the team are based here in this building and we're an active investment manager. So what that means is we try and move in and out of the markets at different times to help people with that investment performance, which is why we're all here. So we have a team here based in Dublin. So we have 15 front office managers. So they're people who are managing the money directly. And then a huge compliance and governance framework locally here in Ireland behind that. What we also have is colleagues in Barcelona and also in Zurich and Switzerland who support us on different asset classes and different pieces of it. So very much we have the independence here locally, but very much backed by colleagues around the world as well. So it's a great resource to have the people on the ground managing the money here. And so when we want to speak to like yourself in the market and to customers, we do get it directly from people.
Yeah, no, it's fantastic, and a beautiful new building here as well. You've got a nice view out here.
Yeah, it's right across the Dublin Bay. So we have been based in Blackrock in Dublin for most of that 30 years as well, which goes back to our track record. Shield Life in the late 70s.
Yes.
Eagle Star when we started managing money in the multi-asset way that we do now in the 1980s through to Zurich today.
And one of the other things I'd love to hear you speak about would be maybe just your investment principles, I suppose, as an investment team, but also maybe just investment principles for clients as well, that you might have some be able to shed some light on that.
Yeah, so our view is there's a lot of shared principles between managing money as a big investment manager like ourselves and what people can do as individuals. So I mentioned a few moments ago that we're an active investment manager and we have a very clear process around that. So the way we manage money is what's known as an active top-down investment approach. What we mean by top-down is we start with the economic cycle. So are we in a boom period, a recession? And that helps inform which different asset classes we can go into. So whether it's the equities or bonds or whatever it might be, and where you are in the economic cycle informs that, right down through to different parts of the world, different sectors, so financial or
industrial,
and then right down to individual holding stock, shares and bonds. So that's the kind of top-down for us, where you are in the economic cycle. And the asset allocation is really, really important.
And I suppose another principle there would be that those decisions are spread out across all the funds that they're relevant to as well. So you're not going to have a fund that's just sitting out there on its own, basically.
No, so the philosophy and the process that we adhere to applies to the funds that we might discuss a little bit later on. In terms of the principles for us, is that top-down investment process has been in place since the 1980s. So you do enhance it, you add to it. So we've added different asset classes, different ways of managing money with funds, but having a clear and consistent process and a framework which you operate in has been very, very important to Zurich, and that's seen in the long-term performance as well.
You mentioned there are different asset classes, and I think over the last 2 years it's become very relevant, the extra asset classes that you've added in some of your multi-asset funds. You might just maybe expand on those a little bit.
Yeah, so traditionally equities in terms of a share of a company, bonds and cash would have been the main levers that people would pull when they're looking at asset allocation. Because as investment markets and as client appetite has evolved, we've added in new asset classes. So for example, we now add company bonds, corporate bonds in-house here in Zurich. We also have the exposure to different alternatives, so the likes of gold or soft commodities, for example, and also property. So different types of property exposure as well. So we do have a consistent process, as I said, but you do enhance it and you add to it over time. And I think having that consistency when we talk about the investment principles for individuals is very, very important.
Okay.
So we have a long-term horizon, so out 10 years plus when we're looking at managing money. And a lot of your clients will have that similar horizon, particularly those in the pension space as well. So know our process. We've been through many ups and downs in markets over years, and most customers and clients will as well if they're saving for their retirement. But sticking to your plan and trusting your process is important for both the big manager and the individual.
And one of the things I like about Zurich as well, like you're your own asset manager, and like you said, it's long term, but that doesn't mean that it's just put it away and forget about it. If you're the type of client who wants to engage with that regularly, I remember you were doing quarterly reports, then you're still doing your monthly reports, but you're doing weekly reports now as well. So for a client who's keen and has an interest in what's going on, like if this is about financial literacy, you could do a lot worse than to maybe tune into your weekly reports.
Yeah, so as you said, we have lots of regular pieces. It's all available. It's all publicly available on the website. And I suppose the what is important, but the why as well.
Yeah.
Because we found, particularly in times of stress, if people understand and comprehend why the markets are down in a short period of time, you're much more behaviourally to stick with that plan, and obviously engage with the likes of yourself and the team to stick with that plan as well. So understanding what your investment is. Now, you can look too much at this stuff, and again,
of course,
might discuss that later on. But understanding, having that clear process, as you said, it's not passive. It's an active approach. We make decisions every day, day in and day out, reacting to markets.
And listen, that kind of brings us on nicely to maybe, when I say a market review, like my clients are invested for 5 years, 10 years, 8 years, 15, 30 years. That's the sort of market overview that we're looking at. So if we look back maybe over the last 3 to 5 years, I'd be interested to hear your thoughts on maybe some of the key points, but also how Zurich reacted to those situationally. So here in the office, like what actually happened on the ground?
Yeah. Well, we were in the office for some of it, obviously, after COVID hit. But if we look back at the last 5 years, I think just looking at, say, the COVID bear market purely from an economic perspective, obviously there's a much more important human aspect. But when we came into 2020, things were looking okay. The economy was in good shape. But we then have this massive shock, this massive event that nobody could have foreseen. One point that we really rely on and really helps us is when we talk about that process and having been through economic cycles, the reasons for bear markets are always different. So it was the financial crisis, it was the dot-com bubble, it's now, for example, in 2020, it was COVID. So the reason that causes a crash or a fall, or this 20% fall that signifies a bear market, will always be different. However, the way humans and the market react, you can learn from the past. So we were very calm. We obviously, it was a shock to us as well. We were. For example, I suppose you asked what we did. Initially, we did nothing. So part of being an active manager isn't always about action.
Yes.
Sticking to the plan and sticking to your process is important. We felt purely from an economic perspective that the panic was overdone throughout March 2020. We actually went further into equities as an asset class.
Yeah.
So again, when people were selling out of equities, we as an active manager went in and we bought equities at that lower price. And that was something that we did on a daily basis. So we have a very close-knit team. When we were still in the office, it's literally across the room. There's a trading floor. People have you have your Bloomberg screens, but you're talking to the CIO is talking to the head of equities. They're talking to the head of bonds. The guys are talking to each other individually.
The full use of all that brain power in one room. It's not kind of going through this and going through that manager and then someone looks at.
Absolutely, yeah. It's just these little tangible incremental pieces that you pick up on a day-to-day basis. So we're able to hold that equity content throughout 2020, and we had the best 50 days ever for the stock market after the fall, and we were able to capitalise on that and produce that sort of return for clients.
And that's so important, like that. We were talking about equities there individually, like, when people talk about risk and volatility, I always say once you get out past that first couple of years, if there is some volatility and we have a discussion, well, at least you had the gains to counteract the lows. And that's the key thing, to be in long enough to get those gains. From a client's point of view, you're managing the overall fund, but the client's only concerned with what they're putting in, what it's worth at that particular time and date. And now, obviously, they're more concerned what it's worth at the time and date when they need it. But, throughout, people are going to look at these things.
Absolutely. And like time horizon is such a benefit of investing. So if you have the patience and the resolve and the good financial advice to keep you on track, we do know history tells us lots of things. History tells us that equities are the best performing asset class over 10 years plus, which is most people, not everyone, but most people's time horizon. And if you behaviourally can stick with that plan when you're looking at your pension or your investment value during COVID, and it's down quite a lot. COVID was a microcosm of understanding markets. You had a very, very quick fall and a quick recovery, but it was in that sense of that moment, you understand what happens over the long run. And people who stuck with the plan learned a valuable lesson. People who didn't and maybe moved also learned that same lesson.
And people probably now who are maybe moving into areas that did quite well last year, maybe who knows what sort of lesson will be learned there as well. I mean, we know that, commodities now are a real alternative to bonds and alternatives, etc. And that might bring us on to maybe talk about some of your fund range. And if it's okay with you, I'd like to start with your Prisma range, because I think they've really, over the last 10 years, they're a very impressive multi-asset fund in terms of the market and in terms of their ability to kind of go from one asset class to another. You're not stuck in a rigid structure. If you feel that you need to move more into one asset class than another, you're not beholden to being 20% of this and 80% in that. You might talk to me a little bit about that and maybe how that's played out over the last 10 years.
Yeah, definitely. So the Prisma funds are our most popular funds. So they see the most amount of flows going into them from individuals, but also in company pensions and things like that. They invest across the 5 main asset classes. So we've referenced them already, but equities, bonds, cash, property and alternatives. And there are some parameters around them. So if you want, as the numbers go, if you want a bit more equity exposure, you'd be in the likes of 4 or 5 or max.
Because of up and down them, you're kind of following the Ezra scale there.
Exactly, yeah. So it does have
but you're not beholden to it.
No, for example, if we talk about that time when we increased equities in the first quarter of 2020, that was obviously very much looking at the potential returns and the best outcome for policyholders, your clients, our customers. And it was the best thing to react as an active manager through that. So we do have the ability to go in and out of these asset classes. And just to talk maybe in the last couple of years, there's been times where we've been more in equities based on where we are in the economic cycle and the top-down process. And there's been times where we've been more in bonds. But also within bonds, when we saw recent inflation throughout the last number of years, bonds don't do great in that environment. So as an active manager, we can react to that and we can change the exposure where we are in terms of different types of bonds to help insulate from some of those losses. So we like to say as an active manager, we don't get everything right. I think there's a humility there to recognise that. But the track record over the long run shows that we're getting more things right than wrong with these asset allocations and these different calls.
Yeah, I mean, even like if you take it to date and you did a 5-year look back on the average rate of return within the risk categories that you're in, a lot of clients would be probably very happy.
Absolutely, yeah. We had a poor 2022, but it's worth looking at, as you say, the perspective on a very good 19, 20 and 21.
Yeah, that's the reality of it.
Yeah.
And like that's the multi-asset fund, and like I'd always kind of describe that as the every person fund. So like, for example, like if say your wife is working for a company and they have a company pension and she goes into a default strategy, she's probably in a multi-asset fund. She's probably in a Zurich fund. And that's fine for sort of default and that's that. But if you want kind of more specialist advice, Zurich, under your investment umbrella, you do have specialist funds available there for somebody who maybe just wants a little bit more and is happy to take a little bit more risk to get that. Yeah. Might talk to me a little bit about those.
Yeah, absolutely. So I think one of the first points to note is when we talk about funds that are managed here in the building, the large majority and the vast majority are under the umbrella of the active top-down investment process. So that is a philosophy that runs through everything. So we talked about the multi-asset funds, we call them the Prisma funds. We also have managed funds, so they've been around since the 1980s with a great track record as well.
Your balanced fund in the managed fund is actually a slide that I use in all of my presentations, that 30-year slide.
Yeah.
So I think it just shows it, like for anybody has a maybe just talking about it in relation to pensions, because funds are obviously used for everything, but just in relation to pensions. So anyone has a fear about their money and pensions over time, I always just show them that slide, because it highlights all the key points where over time through a news cycle, they might have heard something happened and the markets are down, but it shows it in perspective.
Yeah.
I mean, it's an excellent slide, and it's as a result of being an excellent fund.
It's interesting, they've been around since 1989, so you're looking at that almost 35-year track record.
Yeah.
And it's a great tool for clients because, well, if you start early enough, most people have a 30-year timeline to their retirement. And we have people who've gone in the balance fund in the early 1990s and are now retiring.
Well, I think I was probably maybe 4. You were maybe 2 in that last.
Yeah, exactly.
So like, it's great to look back over that time period.
And I won't name any names, but there's the people in the building and the team that have almost been around managing those funds since then.
It's very confident.
So that again, a point we said earlier about going through the cycle and seeing the ups and downs. So they would be the main types of funds that people invest in, as you said, the multi-asset or the managed, but we do offer close to 60 funds across our pension products. So most of them do go in the multi-asset piece, but we do have other pieces. So for example, we have a dividend growth fund that targets a particular type of stock that might be dividend paying.
And a high yield situation.
Exactly, yeah. So you're looking at more defensive companies that are more seen as value, and they're seeing profits now and able to pay them in dividends. And that's an interesting fund because it's managed slightly different than the main equities we have in the multi-asset fund. So you have a diversification in terms of how it goes about its business and what it's trying to do.
Would there be a smaller number of equities within that?
There would be, exactly, yeah. So it'll be more concentrated. And another more concentrated equity portolios is we have what's known as the 5-star 5 funds.
Yes. Yeah.
So they have up to 50 stocks in different geographical areas of the world. We talked earlier about the investment updates we do. Every month for the 5-star 5 funds, we give the full list out in a fact sheet.
Yeah.
So people like
down through them.
Exactly. People like to go in and they like to ask you,
these that I buy off this month.
Exactly. Yeah. And you can see how they've performed and things like that. We're also conscious that we don't have every different type of expertise in the team here in the building. So where we see something that clients might find useful or might benefit from, we're happy to bring in external partners. So we do have external funds from the likes of Blackrock, JP Morgan, and they would maybe have a different type of style or philosophy as well, which is fine. We're making sure that there's enough choice for people that want it. Another type of fund that's quite popular is what's known as our Top Tech 100 fund.
Yeah, and that's it's great to bring that up too, because while a lot of your funds you're actively managed, that's a passively managed fund.
Exactly, yes. That tracks what's known as the NAV.
That's what you want. You can have that with Zurich as well.
Absolutely. We have a way that, again, hopefully a humility inside of us that shows that we believe our way of managing money is the best way of managing it, and track record shows that. But if people want a slightly different view, there is that Top Tech 100, for example, that tracks the NASDAQ 100. Yeah. So tech heavy, not all tech, but majority tech, and that's been very popular for people as well.
And that's probably more so to do with just the NASDAQ itself. The New York Stock Exchange just has a lot of tech companies in it, basically.
Yes, exactly. So what they call your FANG stocks, your Facebook, your Apple, etc.
Maybe the name is maybe a lot to do with the history of the fund as well. When it was started, it was that 99, 2000. So it was literally just at the cusp of the dot-com crash.
Yeah, so look, it's an exact exposure to a specific part of the market. And if we think about what did well during COVID, just to bring it back to markets, these work from home, play from home, deliver to home kind of stock, more tech heavy stocks. However, they didn't have a good last 18 months, for example. So what we will be doing as an active manager is, as we work down that top-down process, is in and out of those different sectors. So we would hopefully get it right that we like tech when tech was doing well, and we reduce tech at times when it's not going well as well. So when you do have these specific explicit exposures within funds, it's always worth knowing that there are parameters around that, and maybe not as much flexibility, but that can be fine as well.
And the precious metal fund as well, that's an interesting one. I'm sure there's maybe a lot of clients out there, whenever the next volatile time might maybe look towards a fund like that. You might talk to me about that.
Yeah, so we have a couple of commodity funds. To talk about one maybe would be the gold fund. And we have gold exposures within, say, the Prisma range.
Yeah.
And the gold exposures in the Prisma range is the exact same way that we offer it to customers. So we're going into the same fund.
Yeah.
One thing on commodities that's always very, very important is to always remember their price in US dollars. So that there's that currency risk piece there. But gold has always proved to be a good diversifier, particularly in times of stress. We've seen it do well in recent times. There are other exposures within the multi-asset funds, but as you say, a lot of people like the idea of using a core multi-asset fund, and they might tag on the Top Tech 100, the gold,
delta percentage and that, etc. Yeah, and then tweaking that at different times potential.
Exactly. Yeah.
Yeah. No, listen, Ian, that's fantastic. That's a great overview just of, I suppose, your investment team. A great overview of the market, an excellent overview of your fund range. Is there anything else you'd like to add?
No, I think it's been great to chat. As I said, we've got lots of information on the website in terms of investment news explaining the funds. But we're a strong believer in the financial broker market as well. The likes of yourself do a great job, and we've talked about behaviours. We can hopefully manage the money in the right way, but having a plan, keeping on track with your financial advisor is just great advice for everyone.
Ian, thank you very much.
Cheers, thank you.
Good man. Ronan, great to meet you.
You too, Shane.
Ronan is the head of marketing here at Zurich, and he's here today to just, I suppose, try and frame Zurich for us, in terms of your global positioning and maybe your Irish positioning as well.
Yeah, thanks very much for that, Shane. When I look at Zurich, I look at our global footprint. We're 150 years old last year. The name might be a giveaway. We are a Swiss company. We're based in Zurich. You'd be surprised the amount of people that ask us where we're from.
Oh my God.
But we are actually from Zurich. They were not very imaginative when it came to the naming of the company. And we're very proud of our Swiss roots. But we've been here in Ireland for 40 years. Started down in Cork about 42 years ago. We started off as Shield Life. We then became Eagle Star. And about
People will be familiar with that.
very familiar with them, Eagle Star, and still very familiar with Eagle Star. But very often we'd have people say to us, there's pensions and there's Eagle Star pensions, which was a tagline that we had in advertising going back many, many years, and it's really resonated with people. But we became Zurich probably about 12 years ago, and we're now part of the Zurich family, part of that global footprint. I think overall we've probably got about 55,000 employees around the globe. Here in Ireland we've 1,000 people, and that's split between here in Dublin and our new offices in Blackrock. We've got about 700 people, and about 300 people down in our operations centre down in Wexford.
Not too bad, beside the beach as well.
We're we really enjoy working in Blackrock. We've got a lovely location. If you're ever passing through Blackrock, you can't miss the building. It's a new building on Frascati Road. We sort of signed the agreement to move into the building before COVID. COVID came, and of course we never got the chance, so it was lying sort of empty for a few years. But we've moved back into this building now about a year ago, and I have to say it's been fantastic. It's great to have everyone together. We've really embraced hybrid working, so we're in the building.
High tech office from what I can see. Even the conference room, if the mics come down from the roof, and just everything that seems well, you'd know it's new.
Yeah, you'd know it's new. And our old building was a number of years old, and we were very used to it. But we really enjoy working in the new building. Lovely canteen, lovely restaurant, great facilities, and it's sort of that hot desk environment which probably none of us were really au fait with, but we've all really embraced.
Yeah.
And it's great for people who have a long commute because they're able to work from home for a few days, come into the office 2 or 3 days a week, and it works really well.
Did you get the corner office, Ronan?
I didn't get the corner office, but I have where the floor I'm on has a great view over of the whole Dublin Bay, and it's really nice.
And just in terms of Zurich, how would you position yourself in the Irish market, or what are the things that maybe distinguish you?
So, people will be familiar with Zurich for a number of different areas. We've got 2 distinct businesses here in Ireland. One deals with sort of our car assurance and motor insurance and farm assurance. That would be Zurich General Insurance. And then on the other side is our life pensions and investment company, and that deals with helping people save for their retirement, help people invest, and protecting families. So the two very distinct businesses. I'm head of marketing on the.
You're on both sides, aren't you? You're the commercial and the personal.
No, I only deal with the life pension and investment side, which is.
Oh, sorry. Yes, I mean though under life pension.
Yes,
investment,
so
you cover the
I both cover retail and corporate customers. So on the pensions and investment side,
this is one of yours here. So
this is There's that's our design team. They put together all of our various branding. It's. And if you were to walk around the building, you'd see that branding everywhere.
It's very good, to be fair. And some of the informational videos that you do, I think, are very relatable, very easy to understand, especially the ones around savings, etc. I think they just they come across very well, the animations, etc.
We deal with complex products. And I think when you speak to people and you talk about retirement or savings, they almost close out. It's not something I want to engage with.
Long finger.
Procrastination is the favourite for many. We try to look at our products and try to simplify them as much as possible, and recognising that we can never simplify to the extent that people might really want, but we recognise that, we can make complex messages that little bit simpler. So we've spent a lot of time investing in how we speak to customers, both from a pre-sales perspective, so before you might invest or save or invest with us, but also then once you're a customer of ours, we really try to make it as easy as possible for you to understand what you have.
Your communication piece is brilliant, on going forward, so for examples of investments and savings or pensions, etc. That sort of weekly sort of report that Ian does, and the fun fact sheets are regularly updated. The communication piece is brilliant there. As a broker, when I have a client ask me about one of the funds they're invested in through Zurich, I have an answer in seconds.
Yeah. One of the things we say to ourselves is we are boringly consistent. And when you work within marketing, marketeers by their nature want to do new stuff all the time, but Zurich's approach isn't that. We say, hang on, consistency is the most important thing.
Yeah.
Consistency in our products, consistency in our performance.
That's what people are looking for.
Consistency in how we communicate.
Yeah.
And we recognize that our customers and our brokers don't engage with our communications all the time. So we recognize that, hang on, they might only be dipping in and out every couple of months. So we need to make sure that the message we give to somebody today is the same message that we give in 3 months' time, in 6 months' time. So that consistency is really, really important, particularly when you want people to understand investments and savings and pension.
We might actually just kind of maybe go into a little bit more detail there. Maybe if we start with the short-term planning and the protection products that you have on offer. Like from a marketing perspective, how do you approach that? Because it's such a sensitive topic. Like I even find the tone of my voice changes when I talk about protection. It's just, it's such an important part of a financial plan. And like for me, I would find it very difficult, in marketing terms to put that across. Could you talk to me about that for a minute? It's so important, but it's hard to talk about.
It's hugely important. Protection is, we look at protection as being the foundation of people's whole financial plan.
Yeah.
If they don't have protection in place, if something bad happens, and we never really want to consider something bad happen to our health, to our spouse's health, to our children's health. But the reality is, and the statistics would bear it out, that bad news happens to people. So we try to be as adult as possible in relation to how we communicate it. You can't go softly. Sometimes you have to be clear with the facts. This is what you need. This is the type of protection you need to have in place. Like we will recommend people have, if you have a mortgage, you have mortgage protection. So if you die, your mortgage is paid off. So if your spouse can continue to live in the home. But people also need additional cover. So that cover might be additional life cover to make sure that your whole family is protected. Or it might be serious illness cover, so that if you suffer a serious illness, such as cancer or heart attack or a stroke, that you might get that sort of payout. Not enough to make you retire. We don't talk about, this is not windfalls.
No.
But it's
about getting through a very financially tough time.
Some money to get through that financial challenge that you will have.
You have your health insurance to cover the medical costs, but then there's all the other associated costs with being sick as well. Extra transport, extra accommodation. Obviously you have your income protection hopefully in place as well.
Yeah.
That's available to you, to keep the money coming in. But then there's extra costs on top of that basically, and the serious illness cover could be quite
huge. All of these can be hugely important. If somebody is diagnosed with a serious illness, let's say cancer, chances are, like statistically, you'll get through it, but it could be a year of intensive medical treatments, and
2 years.
You don't want to be working. You probably will have a lot more consultancy expenses. You'll probably have a lot more expenses that you'll need to factor in. And if you've got savings, you don't want to be using your savings to pay for that. And we talk about savings for a rainy day, but that rainy day is more of a holiday as opposed to having to pay for medical treatment. So having protection in place can allow some of those costs to be covered.
Yeah, and like you mentioned it there, like your three key pillars. You've got your income protected, so that you're still getting paid if you're unable to go to work until you're able to come back, or up until whatever age that's set to, usually a normal retirement age. You have your serious illness cover in there. Serious illness cover obviously being kind of not new, but a newer version of life cover, because life cover's around for a long time, and serious illness cover was, well, listen, wouldn't that money been better off to them, beforehand when they were unwell, etc. And then you have your life cover paid out on death, and mortgage protection just being a decreasing version of the life cover. And I suppose the products that you provide are so important, and then to match them through advice to your circumstances is key. But listen, that's plan, and that's your plan B. Okay.
Yeah.
But you have to have your plan A as well, and your plan A then leads you probably onto savings and investments. Like for example, Zurich, for as long as I can remember, have had a really good regular contribution savings product. So what I mean by that basically is that when people think about investments, they often think about them as one single contribution, one lump sum investment. But for a lot of families, they don't have, or they might never have, that lump sum to invest. But you know what? They might have maybe 420 euro, maybe they might have 100 and whatever euro they might have something they could invest regularly over time for maybe a goal that's further down the road.
Yeah, absolutely. We've looked at we've been in the savings market since we probably started, but we would see it as being really important for people to consider saving with a company like Zurich, as opposed to where people might traditionally go, which might be the credit union. You know, your parents would say, "Oh, put money in the credit union," or saving with your bank.
And to a certain amount, that's great.
And know that they're absolutely great. They're great options.
Yeah.
But the last decade has really brought home with interest rates having been so low, that the money you're saving in the bank or perhaps in the credit union, you haven't been earning a great deal of interest on it. So
interest rates low, maybe starting to rise slightly, but you know what? Inflation has gone through the roof, so it's wiped out any gains you have from any slight increases that might be coming down the road.
So we've had loads of customers come and starting to save with us on a regular basis. As you say, 140, 150 euros, which is similar to children's allowance.
Those clients, right, saving a couple of €100 per month, they have the same access to all the funds to the clients who are investing $500,000, $1 million in a lump sum. Yeah. You know, so it's equitable in that sense as well, which I really like about it.
Yeah.
And then obviously you've all your traditional lump sum options there as well. And you guys also have, a really interesting tool in terms of your auto invest. You may maybe just expand on that a little bit.
Auto invest is I think we're perhaps unique in Ireland in having auto invest, and this is good for those customers who are looking to move from, say, money that they've saved in the bank, and they're looking to put it into a company like ourselves and invest it in the funds when times might be a little bit volatile.
Yeah.
But rather than making a decision on a once-off time, we can drip feed the money. So the lump sum of, say, 20,000 euros can be drip fed into some of our funds over a 12-month period.
Yeah.
And it just allows you to
12 to 6 months, and you have the bullet option as well. If you decide, actually, do you know what, 5 months in, let's just put it all in, you can do that as well. And I find that's really useful for clients who, you know, maybe haven't engaged with financial services for whatever reason throughout the course of their life. They now find themselves kind of in the latter end of their career. Where other clients might have quite a large pension built up, they have quite a large deposit account built up, and they can only get so much of that in through a pension vehicle. They can look at the auto investment maybe through for transferring that money over time, because they need to protect that money against inflation. And the auto invest is a really good opportunity to dip your toe. And then, as we say, you have a mixture of funds and you have the different risk categories, and you know, you kind of cater for it in all ranges. But to the auto invest gives a real good option to dip your toe in investment. And then, like I'd always say, seeing is believing. Do you know, you say somebody invested 6 months ago, and now they're looking at how much they put in and where that's at. You know, 6 months ago, if we had said Credit Suisse, etc., and like that, you know, people thought, oh no, that's a terrible time to invest. But the reality, the impact it's had on the markets to date, you know, it's minimal.
And I completely agree. And you mentioned risk, and one of the things as an outcome of the financial crash back in 2008, I think a lot of people were concerned that if they invested in funds, they were just going to be investing in funds that were very volatile. However, with the development of risk-targeted funds and risk profiling, we can really provide solutions for customers of all palettes.
I really think the Prisma funds, the range of Prisma funds, like I think they, from a marketing perspective, you know, they were very good. Like I think the message on how they operate comes across very clear in your marketing, and like that obviously brings us onto the pension side of things. And you know, all these things we're talking about, I'm talking about them more from a personal perspective, but we also do them from a corporate perspective. So like, you know, that could be for a small family-run company, but you know, that could also be maybe somebody with 800-900 employees.
Absolutely. We launched what we call our Master Trust, the Zurich Master Trust, last year, and this was a key development out of the European regulations, and there's a lot of advice required in relation to corporate pensions, but we would be, as I say, we would deal with small family businesses all the way up to some of the big conglomerates here in Ireland, and we're set up to be able to manage those because we've got great teams of people. One of the things about Zurich is that we focus a lot on the products we offer, the performance that you would have heard from Ian earlier, but also our people. Our people are key to the success of our business. It might be a cliche, but people really are important to us. You know, I've been with Zurich 11 years, and I'm still considered one of the newbies.
Well, it's only a cliche because you work in marketing.
No, but it's I was at a retirement party last year. One of my colleagues in sales, he had 32 years experience, and that's not uncommon within Zurich. And again, it comes back to that consistency. You know, you can consistency in messaging, consistency in our proposition, but consistency in our people. You know, the people within Zurich have grown up with Zurich, and we're also vested in the success of our company, but also making sure that customers are really looked after. And when you work for other companies, and I have worked for other companies, and you can see a transition of people on a regular basis and like a transition of strategy, and that doesn't make for a great customer experience.
No.
With Zurich, because we've been around for so long, our CEO started off as a trainee actuarial student. He's now the CEO. And that path you could see from...
And how many people all the way through, you know, passed information on to. And it's where you don't have that high turnover situation. You've got people with lots of experience walking out the door, people with no experience walking in and no one to pass it on to them. Like what you're talking about there is a prime example of that kind of knowledge passing down through the generations. And like it's key, like it's absolutely key. We're very lucky in Clear Financial. Yeah, we've a similar setup. And like the backroom staff, you know, are huge when it comes to customer service. When you ring us, you know, you're talking to one or two people who basically would pick up the phone every time.
Yeah, no, it's usually like I have two people who just joined my team on maternity cover, and both of them are saying to me that Zurich is probably the most seamless role that they've come into, because they were able to shadow the people who were going off on maternity leave for a week or two to learn the process, and then being able to pull in the knowledge base of other people around the organisation. So it's a very intangible thing to be able to describe and to be able to measure, but it's immensely important. And when you come to work for Zurich, you see the same faces. You could disappear for 5 years and come back and say, oh, there's Joe or there's John or Mary or whoever, and they're all still around. And we see that as a huge positive to us as an organisation.
100%. Well, listen, it's credit to the organisation. Ronan, thanks a million for taking time.
Thank you very much.
I really appreciate it.
Great, thank you.
And thank you for watching.